IRS 2026 tax changes, the one big beautiful bill, and what U.S. companies in Canada must know. Here's something every U.S. company operating in Canada needs to hear right now. 2026 is not a normal tax year. Between new IRS legislation, shifting compliance rules, payroll reporting changes, and a shrinking IRS workforce, this filing season is shaping up to be one of the most confusing we've seen in years. And confusion in cross-border tax? Well, that's where mistakes get very expensive. So in this video, I'm going to walk you through what's actually changing for U.S. companies with Canadian operations and the 5 key strategies you should be thinking about right now to stay compliant and protect profits. So let's get into it. Hey, I'm Duncan McPherson. I'm a dual qualified CPA in both the United States and Canada, and I spent most of my time helping companies navigate the messy middle between the IRS, the CRA, and everything that can go wrong in between. And I'll tell you this straight, when major US tax law changes hit, cross-border businesses feel it first, and they usually feel it the hardest, especially in a year like 2026. You may be asking, so why is 2026 so different? Well, let's start with the big picture. The legislation people are calling the One Big Beautiful Bill isn't just another routine tax update. It introduces new compliance requirements, retroactive rule changes, payroll reporting updates, including tip reporting under IRC 224, and tighter enforcement, even though the IRS workforce has dropped 27%. And by the way, the same dynamic is happening up here in Canada. The CRA workforce is dropping. Now think about that for a second. More rules, fewer agents, more automation. That combination always leads to one thing: computer-driven enforcement and less room for error. And that matters even more when your business touches both the US and Canada. So what should you actually do about this? Well, call me for one. But there are 5 strategies I want to walk you through today. First thing is this: get absolutely clear on your compliance footprint before tax season begins. With retroactive law changes in place, you cannot afford uncertainty around entity structure, payroll treatment, cross-border reporting, or your prior year's filing positions. Because when laws change after the fact, the companies that suffer most are the ones that never documented their positions clearly in the first place. I've seen this over and over again in the last 30 years. Clean documentation is no longer best practice. The second strategy is this: treat payroll reporting as a high-risk audit zone for 2026, especially when it comes to tips and service income. The updates tied to IRC 224 signal something very important. The IRS is tightening visibility into real-time compensation reporting. And for cross-border businesses, payroll confusion already exists between U.S. reporting and Canadian payroll withholding, treaty exemptions, and shadow payroll situations. Add new IRS scrutiny on top of that, and payroll becomes one of the fastest ways to trigger trouble on both sides of the border. This is an area you want reviewed before, not after you file. The third thing I want you to do is assume that enforcement is automated, not human. With the IRS workforce down significantly, the system is leaning harder on algorithms, matching systems, data analytics, and exception reporting. Canada has operated this way for years. Now the US is catching up. That means the real risk in 2026 is not an auditor knocking on your door. It's a computer flagging your return instantly because something doesn't reconcile across borders. And once that happens, fixing it is always more expensive than preventing it. The fourth strategy is reevaluate your cross-border structure under the new US rules. Anytime major US legislation passes, it can quietly affect your GILTI exposure, your foreign tax credit usability, your intercompany payment treatments, and your repatriation efficiency. Even if Canadian tax law hasn't changed, the US side alone can shift the math enough to make yesterday's strategy ineffective or even risky. And this is exactly why cross-border strategies must be reviewed every single year, not just when a crisis shows up. Lastly, move from reactive tax filing to proactive cross-border filing. This is the big one, because the companies that are winning in complex tax environments aren't the ones that are chasing deductions in March. They're the ones building clean books, clean structure, forward forecasts, and documented strategy before December 31st. 31st, not at the time you file. 2026 is not the year to figure it out later. Let me give you the honest truth, big world perspective. From what I'm seeing with clients right now, the biggest risk in 2026 isn't any single rule change. It's misunderstanding how all of the changes interact between Canada and the United States. And that's where preventable problems get very expensive. And it can all be avoided with a little bit of planning before the end of the year. But hey, it's after year end now. It's still not too late. There are still strategies available. So if your company operates in Canada and you want clarity before filing season gets messy, here's the next step. Go to my website, themactax.com, and book with me a no-cost cross-border tax strategy call. We'll look at your current structure, your compliance exposure under the 2026 rules, and what adjustments, if any, need to happen now to keep you protected on both sides of the border. No pressure, just clarity. And in a year like 2026, clarity is a commodity, and a very valuable one at that. So here's the takeaway. 2026 is not business as usual. New laws, new enforcement, and less margin for error. But with the right planning, it is completely manageable. Stay proactive, stay documented, and stay compliant on both sides of the border. I'm Duncan McPherson. Stay sharp, and I'll see you on the next video. Take care.